So, ladies and gentlemen, thank you for joining us for this ISSA podcast on the voice of the customer and DLT. We sent out a survey to a number of clients, asset owners and investors and asked for their opinions on what is going on and the asset types they're interested in the digital asset arena. We've taken that, we've produced a paper, and now we're having a podcast on the paper. So today I have 4 guests. Catherine, if I can start with yourself, if you can introduce yourself, much appreciated.
Thank you very much, Colin. Catherine Kohler, I am coming from Accenture, and at Accenture I am focused on all things digital asset, tokenization or digital money related to capital markets and also the wider ecosystem. We're engaged with financial institutions, regulators, central banks, infrastructure providers, or also institutional investors as the buy side the survey was about throughout the globe. And with that, over to you, Ankush.
Thank you, Catherine. Ankush Zucchi from ISSA Market, where I am the global product and business head for corporate actions and securities processing, responsible for defining the overall business, commercial, and product strategy for ISSA Market suite of enterprise technology solutions and managed data services for asset servicing and post-trade securities processing. I have around 20 years plus experience in product management and delivery of platforms in this post-trade space, where we work with multiple financial institutions across the globe, helping them deliver on their technology and business transformation initiatives. Quite excited to be here. Over to you, Hari.
Thanks, Ankush. So I'm Hari Chaitanya from Standard Bank Group in Johannesburg, South Africa. I'm responsible for the custody product and our investor services business across Africa, which is 15 markets in the sub-Saharan region, offering the range of custody services, trustee, accounting, derivatives clearing, and securities lending to the institutional investors in this region. And yeah, great to be here talking about digital custody in this panel.
And finally, but not least, we have Jörg Unger from Swiss Re. He is the head of custody at Swiss Re. Jörg, thank you very much for joining us. Given you're part of a very large asset owner, could I start the questions with you, please? Firstly, just to set the context, can I ask whether Swiss Re is active in digital assets at this time or not?
No, at this point in time, we are not active in digital asset, which means we do not have any investments at this point in time. And also, I think it's not going to be today and tomorrow when we make investments. However, we are very, very closely watching the space to understand, what are the developments in the market, what happens out there, what are competitors doing, to be ready when the time has come, because we truly believe that digital assets as well as the technology blockchain is going to stay.
Excellent, thank you. And then a follow-up question to that then. The survey said that a substantial proportion of the market, roughly 60%, is not looking to invest in digital assets within the next 2 years, if ever. And those that are investing, 40% said that they would invest less than 1% of their assets. Why do you think this is?
That's a very good question, Colin. I believe that there are multiple reasons. I think the main reason at this point in time, in my opinion, is that the financial service industry is heavily regulated. Today in the traditional markets, the issuance, the storage, the trading and the transfer of securities is fully regulated. It's only executed by regulated institutions. And obviously, if you go to the digital asset space, crypto space, this is just not the case. It's kind of a wild, wild west. And for institutional clients like Swiss Re, I think for us it's absolutely paramount that those 4 things are just regulated. Otherwise, we are not going to make the investments. And I believe that many other investors feel the same way. I think the second point is, for me, I think in many areas the market is completely immature. You know, you have a lot of liquidity, of course, in things like Bitcoin, Litecoin, and others. But then if you talk about digital assets, again, often maybe you can buy something very complicated. You do not have a lot of liquidity. Again, things are not regulated. It's unclear where you store your assets, etc., etc. And I think the last reason is often those solutions are not yet really integrated into the whole financial market infrastructure, because just by buying and selling digital assets, the job is not done yet, because you may need someone who provides liquidity for the settlement, as large global custodians do today. You know, if you buy and sell at the same time, but if you buy a crypto, buy and sell at the same time, I mean, those facilities, that infrastructure is just not around.
Okay, thank you very much for that answer. Ankush, when we were writing the paper, you made the comment that you were surprised by the investors' motivations to be active in digital assets. Can you explain why?
Sure, Colin. So as you know, one of the key insights from the survey, which was also a bit surprising, was that the top motivations for asset manager owner respondents was actually improving efficiency across the market, and that was followed closely by lowering costs, with 83% and 72% of the respondents respectively saying that. So that was a bit different from what we thought we would see. We thought you would see investment diversification and client demand as a top driver, in line with some of the other surveys, especially given the high potential, high upside potential or arbitrage opportunities in an uncorrelated nature of these assets. But they came out to be lower. But overall, it was interesting, and what we think is that this reflects how asset owners believe this whole asset tokenization may deliver efficiency gains, resulting in cost savings. Now, that could be due to the faster settlement cycle, which would directly enhance investor protection by reducing counterparty and principal risk, and also improve the liquidity due to reduce delay in change of ownership of assets. But moreover, this shorter settlement cycle driven by atomic settlement, that could also help investors benefit from release of capital otherwise held in margin and risk-based margin requirements, indirectly impacting liquidity. And moreover, this whole use of smart contracts, etc., resulting in automation, may reduce the cost of issuing and administering and further servicing these assets. Plus, some of it also might be because of the lower illiquidity premium, since these tokenized assets will enhance the liquidity of such assets. So probably the investors can get much closer to the fair value because of the liquidity. So overall, we think there are these various factors because of which the top motivation came out to be efficiency and lower costs. So that was a bit surprising anyway.
I think with the assumption of efficiency or lower cost, there is also an expectation that the digital assets can also help in expanding the investor base and get more people to invest, especially from an Africa context where the financial inclusion is a big agenda. I think the lower cost of issuing securities and whole clearing and settlement process probably can also help in getting more issuer to come to the digital trading venues and raise capital there. So clearly there is a benefit on that front as well. Just to
Okay, thank you very much for that. Harry, you're part of a large custodian and are regularly talking to your clients about their needs. Can you talk to the challenges faced by the investment managers and asset owners, and which of the findings you see in your day-to-day dealings, and whether there are any further surprises for you?
So the findings are largely in line with the conversations we are having with clients on it. And client demand is slowly emerging as number of investors would like to invest in crypto assets via funds instead of going directly onto the trading platform. And that trend is now getting increasingly strong, especially in view of some of the recent incident, I said globally, including a couple of them in Africa as well, where some of the trading venues dealing with the retail investors, disappeared with the investors' money. So I think the focus has clearly come back onto institution on both front, how you invest and where you keep it. So I think the conversation in that sense is aligned. The key issue for the clients as we talk to them is around the lack of regulatory clarity around what is allowed and not allowed. That is a key issue at this point of time. And especially when you look at from the perspective of pension funds and unit trust, because their investments are heavily dictated by the mandates they have, as well as the regulations which are there in the respective markets. So the regulatory clarity becomes very important. The second point is around the lack of approved products in the domestic markets. So in the absence of that, there are not many opportunities for the institutional investor at this point of time to really invest. And this becomes very important, especially in the markets which have the exchange control restrictions. So they can't really easily go out and invest in various kinds of Bitcoins and other coins outside their home market. So there is an issue around that. And the third point is around the market infrastructure and service provider. But I would say it's a lower point because if you don't really have the regulatory clarity and the availability of the product, then frankly, the readiness of the infrastructure and service provider is not that critical.
Maybe adding to that, to your first point, Hari, about the incidents which we see on a global level, and that really indicates that there is a need for trusted parties and for trusted service providers, so that investors on a retail, but also on a more institutional investor level, can rely on the service providers to be a trusted party, and that they can actually engage with digital assets, because currently this is still a missing piece to some extent.
Katrin, Accenture is heavily invested in its DLT practice and has a number of clients worldwide. We asked an open question about the services that investors need. What are your clients asking for help with? And are there any surprises to you in the answers, both in terms of the requirements and how they are looking at suppliers?
So what we see in the report is that the buy side is looking for services actually throughout the full value chain, and is looking for support regarding technical, operational, but also on other aspects. So really the full range. Given digital assets are a relatively new phenomena, it is not surprising that the financial services industry, as a very heavily regulated industry, needs time to absorb the potential of this new technology, and that the adoption doesn't come overnight, but that this needs time to actually evolve throughout the value chain. I therefore perceive the survey answers quite in line with discussions and also engagements which we are having around the globe. It's about defining new market concepts, and this takes time. Market participants need to adopt. You are actually reassessing entire value chains, which you want to adjust at certain points. New roles and responsibilities are created, and that just adds up that the whole ecosystem needs to adjust. And looking especially at the buy side, it really is about adoption in the industry as a whole, because the buy side just standalone won't be able to absorb the change. So until the buy side can really benefit the infrastructure as well, to some extent also the whole ecosystem needs to be set up for the whole market to really function again.
Jörg, not only do you work for a large investor, but I know you're active across the industry. The survey highlighted a number of criteria that investors were using to invest or not invest. During your conversations, have you heard investors are looking at digital assets as a new gold and trying to understand downside protections, or are they more led by regulation and client demand?
I think there is not a one fits all answer here. I think in generally, I think when I have conversation, within market players, within peers, I think people believe that there is a long-term value in digital assets, but in particular also, the promises of blockchain technology. So that's why in general, I believe people would like to have some exposure to digital assets, to blockchain. But it's whether there is client demand to do it. I think that really depends who you are. I think we as an asset owner, we do not have client demand, right? So that's our own choice really to do it. I guess if you are a hedge fund or a family office, you may have demands from clients to do so. Right? I think there's not like one criteria in particular which kind of boosts certain participants to invest or hold back on investments.
Excellent, thank you. Harry, when we asked about the service providers and digital assets, we got every possible answer, but with a larger proportion expecting a mix of existing providers and new ones. Do you see this in your conversations, and is Standard Bank taking the same approach?
Yeah, no, I would say yes. I think, again, our conversation is in line with the surveys finding, where 55% of the respondent expecting existing custodians to provide, custody for digital assets as well. And I can understand, because the asset safety will remain a primary objective, even in the case of digital asset. So from an institutional investor perspective, they would prefer the existing provider who are regulated entities to help investing in this asset class as well. And the other point is also around, we will have the institutional investors investing a small portion of their assets into digital assets in the big name, which effectively means that if they go for a separate provider, then in a way you are fragmenting your service provider and then bringing all the information together. So purely from an overall operational efficiency as well, it makes sense for them to keep the legacy assets and digital assets with one provider, as long as that provider can service them effectively. So I definitely see that coming up in the conversation as well. Having said that, I also see probably a model where, let's say, the institutional custodian working with the non-bank custodian or the fintechs, sort of in some kind of a partnership approach, also to service in case of digital assets. We are already seeing some of these examples coming up in various regions, and considering the technology is the key part of the whole proposition in this case. So we can see that mixed approach as well, but clearly from institution as well as from regulators perspective, they would like to see the regulated entities safekeeping the assets for the institutions.
Ankush, you laugh every time I bring up my pet topic of atomic settlements. However, the survey suggests investors have not thought through all the implications. What are the top 3 things you think they need to consider?
Yeah, sure, Colin. So I think it's quite interesting where asset owners actually need to consider this atomic settlement, this instantaneous, simultaneous transfer of tokens with a more holistic view that actually weighs the benefits derived from the speed of settlement, like reduction in cost of clearing settlement, against also the potential undesirable implications of such a model. Especially to financing, liquidity, and legal risk, and those are the top three things from my perspective. Pre-funding and financing considerations for one, given that this whole tokenization with atomic settlement is likely to be DVB model 1, which means trades have to be settled on a real time on a gross basis. That would require pre-funding of accounts prior to start of trading, and everything to be paid in full by investors with cash in hand, securities owned before the trade. So that makes it quite difficult for dealers to offer margin financing, would place a tremendous drain on resources, needing them to have unlimited pre-funding resources. So this could definitely hamper some of the margin purchases. Plus, more complex mechanisms have been established in the traditional markets to actually get efficiency, like short selling, securities financing, or back-to-back trades. So a number of other mechanisms which will have to be looked at. The other point is the ramifications for liquidity aspects. Second key consideration. So today, the security markets achieve a lot of efficiency by allowing transactions between matching counterparties to be netted, and this is extremely valuable in reducing cost of cash, credit, collateral, and helps free up trillions of dollars of capital each year. Now with atomic settlement, this netting won't be possible, and counterparties won't be able, or they'll have to find more cash to settle and more securities to post as collateral. So there is a material impact from that perspective. And finally, the third consideration from my perspective is the legal considerations. Like any institutional investor in crypto assets would also prefer the transactions be settled safely, efficiently in a regulated environment, like as Hari was alluding to before, which is comparable to the securities markets of today, right? And that requires a DVP settlement with legal finality, eliminating any possibility of reversing the transaction, and the transaction has to be deemed final and irrevocable. And we do get that today through settlement finality directive, like in European Union, but there is no common legally defined moment for finality of settlement in the DLT environment. And even though we get DVP through some mechanism, there's still uncertainty in terms of finality of that DVP settlement. So if we transfer cash in one ledger and securities in another ledger through tokens, but it can be reversed back in one ledger, then this is this whole principal risk exposure that comes into play. So legality of settlement would be a third consideration from my perspective that investors and asset owners need to consider.
Thank you. That's a great list. Any to add to that, Catherine or Harry?
No, I think Ankush has covered it well. I'll just maybe add a point. I think we are sort of moving from current environment where finality is coming more from the legal aspect to in a DLT environment where it's coming more from the technology. Because that's how the technology is supposed to work, that it creates those irreversible positions, once it's done. So I think that is still not as well understood probably, and I think it comes out in our finding as well, where people saying that good question, but they still need to figure it out.
Maybe a consideration which we don't hear that often yet is when we talk about atomic settlement, which asset classes is it very suitable for, and which asset classes might be also well processed in systems like we have it today. Is there in the future maybe a distinguishment between how you settle different asset classes?
Yeah, I think I definitely agree to that. Some asset classes like loans, private equity, where the settlement, etc., is very cumbersome today, especially like leveraged loan space. I think these are some spaces which can really benefit from DLT in terms of a faster settlement cycle.
Great conversation. Thank you. And can I finish, please, Katrin? Collaboration, standards, and regulations. All the survey answers align to our initial thoughts that we as a market should collaborate widely, standards are needed, and the regulatory certainty is a prerequisite. How do we as an industry go from here to there efficiently?
That is a very crucial question, Colin. And coming back to the fact that financial services is a complex and very interlinked animal, collaboration amongst the different participants, I think, is the key ingredient to efficiently and effectively develop the new standards, which can then be adopted by the whole market and by the whole wider ecosystem as well. It's important that efforts and standards reached in the traditional world, which also took a considerable amount of time, are being built on and expanded, and that we don't just start off from a blank sheet of paper again, but that we really build on existing frameworks. Also, from a legal and regulatory perspective, a coordinated approach across jurisdictions is very favorable, as digital assets are global by nature per their design, and their potential should not be stifled by diverging regulatory frameworks just when crossing borders. And adding to this dimension, I think industry associations and cross-company working groups, bringing crucial players together to facilitate for the dialogue, and to really also inspire conversations and discussions, take a key role in enabling a smooth transition from here to there, as you said. And I would therefore encourage the market players to really engage in discussions actively, because it is about shaping the future, how they operate in the digital asset space, and ISSA is a great place to do that.
Thank you very much, Katrin, for the plug. Much appreciated. Given the time, I think we should wrap up now, but thank you very much to the team. Much appreciated your input. Hopefully this will be widely listened to. For those of you who have not read the paper so far, it's on issanet.org.